The number of companies that continue to announce dividends, special dividends in recent days continues to mount as, of course, they seek to avoid tax hikes that might kick in at the end of the year if the fiscal cliff is not dissolved away. CNBC's Robert Frank joins us now with more on that. Good morning.
Good morning, Simon. Thanks so much. Well, more than 110 companies have announced special dividends in the fourth quarter. That's 3 times last year's fourth quarter. The reason? The fiscal cliff. If we go off the cliff, tax rates and dividends could more than triple or nearly triple from 15% to 43.4%. Companies are racing to beat that tax hike by paying dividends before December 31st. And some of the biggest beneficiaries are insiders and CEOs. Now, Mickey Arison is getting $89 million from that Carnival dividend, giving him a potential tax savings of up to $25 million. Now, Larry Ellison is getting $199 million from an Oracle dividend. His savings alone, $56 million. Tom Frist at HCA, the hospital operator, will get more than $350 million from the company's dividend, saving a potential $100 million. KKR and Bain Capital, of course, will also get a piece of that dividend. And the king of all dividends this quarter, Sheldon Adelson, who gets $1.2 billion from Sands Corp. His tax savings on a dividend alone could be more than $340 million. Of course, all shareholders benefit from dividends, and many of the CEOs and owners recuse themselves from the dividend votes. But these companies tend to have higher insider ownership. The average inside ownership for these dividend payers is around 27%. The average for the market as a whole, around 7%. It all shows that if you can take next year's income today, you can also beat the tax man. Simon?
Yeah, I mean, the question remains the degree to which you're actually harming the businesses by forcing cash out of them now. You know, if there are companies that are borrowing hundreds of millions of dollars, borrowing up, leveraging up the company in order to shoot that money out now. Now, that may be tax efficient in the short run, but when interest rates rise further down the line, or if the economy suffers, that may not be in the best interest of the business, Robert.
No, that's absolutely true. And I think you put your finger on it. It's where these companies are borrowing to fund these dividends. That's where I think we should look more closely. A lot of these companies, again, these were dividends that were already scheduled for next year. They had the cash. They just accelerated them. And there, I think it's an easier case to make.
I think also it's worthwhile to point out that a lot of companies today are much less leveraged than they have been in the past. And a lot of these companies also have the cash and choose not to use that cash for repatriation reasons.
Some do, some don't.
Some do, some don't. HCA is leveraged 4.5 times. That's a lot, but they're happy with that.
Choice Hotels
Sheldon Adelson is adding some debt to or already debt-laden balance sheet. But you're right at the same time. I mean, it's all about your ability to pay the cash back. Capital markets have never been more open when it comes to fixed income and at lower rates. And, of course, that is usually that's a fixed income that they are paying. So they know what they're going to be paying.
I think the next question, Robert, too, is how many insiders will actually start selling their stocks in order to pay less on capital gains. There was a filing on Friday by the CEO of the NASDAQ, Bob Greifeld. He is adopting a 10b5-1 stock offering plan to sell up to 1 million shares. Rich Repetto at Sandler O'Neill interprets this as mainly driven by tax reasons. So that could be the next step of this.
Absolutely. I think the CEOs are going to do less of that because of the profile and the publicity. But I think shareholders as a whole and the wealthy as a whole are selling anything they can this year that has a capital gain to take those gains now, whether it's real estate, whether it's private companies like George Lucas we've talked about. I mean, why not? If you can manage that income forward to this year and accelerate that income at a lower tax rate, why not? And this shows, again, that tax rates do matter. It does affect investor and CEO and company behavior.
And at the risk of being repetitive, let me say again, it's going to be a very interesting end to the year when these companies go ex-dividend. And suddenly, particularly if they borrowed, they pay out that deal, or the register goes through, and then they plunge. That's going to be a really tricky period, potentially.
And we should hold them to it. We should keep an eye on these companies, especially.
Robert, thank you for your time. Robert Frank there, back at HQ. Thank you.
Well, with this slew of dividend hikes that we've been seeing, we want to explore which companies could be next in line. Jay Kaplan is co-portfolio manager of the Royce Dividend Value Fund and the Royce Total Return Fund. Jay, great to speak with you.
Good morning.
Do you actually try and pinpoint which companies may be next and invest accordingly?
We really don't. But if you think about the strategy we have at Royce, which is really good companies with really strong balance sheets and high returns, we tend to have companies that, number one, have the ability to pay dividends. And as we're seeing now at this point in the year, there are a number of companies that are overcapitalized, have, as you were talking about before, strong management ownership, family ownership, that are doing the right thing and trying to maybe get a little bit ahead of the tax man. And all shareholders benefit. So if management pays themselves, well, we get paid too.
Are you concerned at all that should taxes on dividend gains go up next year, that it will change the way investors perceive dividend stocks and maybe a dividend mutual fund like yours?
Well, I don't think so. I think the prospect of higher rates is probably well known by now, and it's baked in. And between that and the prospect for increases in capital gains taxes, we've seen the market be a little bit weaker since a little bit before the election. So I think a lot of that's already been anticipated by the marketplace.
Jay, you've just repeated what we've heard several times in the last few minutes. All shareholders benefit from the payout of these dividends, which is true. And that's what this network exists for. It is for investors. But they're not the only people the only people playing in the economy. Let me ask you a question. If you take this cash out of companies, is that good for jobs and growth next year? That the businesses, that the engine of the economy has less oil in it, it has less cash. Do you think that jobs potentially could be cut?
Well, I think it depends on the company, and you have to look at the company, and you have to look at the capitalization of the company. On the one hand, like you talked about before, there are some very large companies that are going out and they're borrowing money at very low rates, which may be okay today, but if things slow down, that could be a little bit tricky. For us at Royce, most of our companies that are paying special dividends tend to be overcapitalized. They have cash on their balance sheets that at the moment is earning zero and really has no impact on the underlying day-to-day business one way or the other. And we've been for quite some time urging companies in a zero interest rate environment to try and give some of that money back, because that's actually capital that's been relatively unproductive. We'd rather have them give it back to us so we can reinvest it in places where we think we can actually get a higher return. So I don't think it's necessarily bad.
Jay, you ever seen a period like this in your experience?
I haven't seen one like this that was so tax-driven. Years and years ago, I was in the junk bond business, and you used to see a lot of financial engineering and leverage recaps where companies would borrow a lot of money and pay dividends. I know that happens a lot in private equity today, but we haven't seen that in the public markets. But in terms of tax-driven activity like this in my career, I haven't seen it, no.
You know, the thing we also haven't seen, Jay, is a mass repatriation of cash from abroad. So whilst the cash here might be returned to shareholders, you don't have the tax guys in these big companies saying, actually, now it's worthwhile to bring what is the figure? Is it 1, 2, 3 trillion that we talk about?
About 1 trillion, 1.2 trillion.
That they have offshore.
Overseas.
They're not talking about bringing that back to the United States, are they?
No, they're not, because the rates are punitive. But, you know, we, in fact, have some companies where that is a big issue. They show really large cash balances on their balance sheets, but most of it is overseas, and bringing it back at a full tax rate wouldn't be great for shareholders right now. I think those companies are waiting and holding out to see if we get some bigger tax reform that would make U.S. corporate tax rates more competitive, allow some of that capital to come back and maybe be reinvested, maybe be given back. Either way, it's sort of trapped, and hopefully there'll be some resolution next year on that issue.
All right, Jay, appreciate it. Yeah, we'll see. I haven't heard anything on that repatriation. Not sure that's going to come up. Jay Kaplan, co-portfolio manager of the Royce Dividend Value.